Hello, everyone. I hope you're doing well in these extraordinary times. Welcome to the FF Virtual Arena. Today, we're going to be talking a wee bit about payments innovation. And the question I'm going to basically put out there is the future closer than what you think? I'm quite excited for our guest today. First up from 11FS, FinTech Insider and Blockchain Insider, we have Simon Taylor. Simon, how are you doing? Whereabouts in the UK are you at the moment?
Just outside of London, about 10 miles east of London, a lovely little place called Gidea Park. Very, very excited to be with you again, Ali. Always excited to talk fintech and the future of payments. Let's do this.
Yeah, I don't think you've ever spoken about the future of payments before, Simon. So this is going to be
No, never. So this is a first for me. Go easy on me, go gentle.
Hey, so on the subject of future of payments, we have Ray, CEO of PBS. Ray, how are you doing today?
I'm doing very well, thank you. Yeah, it feels like everything is moving incredibly quickly. You talk about extraordinary times. Well, we're coming out of our 5th, 6th, 7th lockdown, I can't remember. And I think we're all learning to live with where we are. So excited about getting back into the office, getting the teams together. So yeah, definitely.
Excellent. Right, let's kick things off. Let's look big picture. Big picture. So first of all, payments have evolved rapidly around the world in the last 5 years. I mean, I'm not that old, but I genuinely remember going to a bank branch with filling out one of the paper forms in order to do an actual payment. So first of all, what are some of the biggest milestones that's kind of caused this evolution? What's been some of the big sparks? Simon, can I go to you first? What, from your perspective, has been some of the biggest sparks that have really pushed payments to where we are today?
I think you got to go back to 2009-10 for me is when Stripe and Square appear and really sort of change what payments mean to people. When payments became API first, that doesn't mean doing what you used to do with XML. It means being API first and API first businesses. They unlocked a whole world of innovation for developers. And when you empower developers, new amazing things start to happen. And when you do things and focus on them. So Stripe, as we know, is valued at 95 billion US. Square is valued well over that, or somewhere in that neighborhood. And those are massive businesses that we now take for granted. And so that was a major shift. Number one is changing payment acceptance. To be developer friendly, to be software native, cloud native by default. And that was a real shift. All of the same suppliers and all the same ecosystem and all the same infrastructure was there underneath, but now developers could use it in a way that made sense for developers in modern software stacks. And I think a lot of the innovation we've seen on the acceptance side has come from that. As I think about making payments, we've seen similar things really start to emerge in the last sort of 5, 6, 7, 8 years as companies like PPS and GPS, and of course then some of the newer providers that sit above that, some of the program managers like a Rails bank, have again focused on developers. And we see that entrepreneurs and builders have built new experiences for consumers. And the entrepreneurs and builders that built those new experiences changed the default. They changed the expectation. They changed what people need to do. So now when branches were closed during the pandemic, suddenly we had a reference, we had a benchmark for all of the incumbents to look at and say, well, we could at least copy that, and maybe we could do a little bit more as well. So becoming cloud native, software native, developer focused, I think has been what's really shunted us forward. And then not having physical retail anymore meant that digital was not the sort of nice to have. Digital became the default. Developer first is now the default.
Ray, can I get your thoughts on there, particularly around, I love that as a line, developer first. Ray?
Yeah, it's definitely the way you have to work. And I was listening to or speaking to someone from a big 4 retail bank, and they were selecting a technology provider. And in their scorecard for their RFP, there was one line which is, did we have to pick up a phone and speak to someone? And if they did, you got a negative score. So you basically got a negative score when you were prospecting, you had to do that. So that shows you how far. And typically a developer will do the first engagement online and then go to their commercial team to say, forget about these guys, they're nowhere close, these are the guys you need to talk to. So that's that piece. I always like, you talk about innovation, payments, and how far back do you want to go, but the one that where I would go back to, I love the story about Diners Card, in the 50s. That's where all basically, the card payments and this kind of remote payment, that's where it really came from. And it was the same as today. There was a problem or there was an opportunity. You had restaurants and you had users, and some guy said, well, why don't I go to these restaurants and say, will you accept this card? And there was only like 10. And if you accept this card, I'll give it to these users and I'll make sure they can only go to your restaurant. So immediately you solved, a business problem, and there was a commercial opportunity there. And that was literally the first credit card, right? 10 restaurants in New York. And then, how far do you want to carry on, whether that's, ATMs opening up. Obviously, digital, as Simon's alluded to, has driven a real need to move away from analog, cash and checks, et cetera. And I would say from a PPS perspective, it's actually a combination of three things, really. It's the user expectation, and that comes through sometimes other industries. So, mobile was not a payment mechanism when it started, but suddenly it became the thing people expected to use to engage with their bank, and banks originally, they used to outsource their mobile apps because they thought, as Simon said, well, it's not really that important. Suddenly they realized this was the single most important way they would talk to their customers. And obviously, if you look at disruptors on the web, originally commerce needed some provider, so PayPal came in under Player X. So there's always kind of a user thing. You need the tech there, but sometimes the tech is not the most important thing, though. The tech is usually been sitting around for years, and then someone decides how they can move it in there. And the last thing I would say, the regulator has kind of got it. We do have to give credit to the regulator. From our perspective, we're an e-money institution, and electronic money was designed to allow for payments to be used by non-banks in sort of business applications. And that's where the first, prepaid cards came from. And that's where guys like Monzo, Monese, and Revolut all started as e-money institutions, because it was a way of getting into payments without being a full bank. So it's a combination of those three things.
I love that sort of stepping stone that they all seem to take.
Yeah.
I do want to bring the conversation. I'm going to bring the conversation a little bit back to COVID. Can we just imagine for a second that there was no pandemic? Where do you think there's a lot of fantastic? Jordan, load up the big wrecking ball of COVID and the team saying digital transformation is going to get driven from within, or the one I mean. That's the one. All right. Would it be what would the payments landscape today look like, and what do you think we would be talking about if there wasn't a pandemic, if we hadn't had a huge kind of move towards e-commerce and electronic payments? I mean, what do you think the contactless limit would be in the UK without COVID?
Yeah, I think the topics would have been the same. The action would have been less. It's like the crazy thing with the future is it's already here. It's just not evenly distributed. There are already people that live in the metaverse and have anonymity and all of that sort of stuff. And I'm still struggling to get my head around TikTok, honestly. Like I'm a boomer, I'm aging out of these things. So like the future is here, it's just not evenly distributed. What the pandemic did is just made everything faster. I don't know that the topics would have been that different, honestly. If I think about everything that's sort of happened, they were all there, they were just a lot quieter. Similar with a lot of inflection points in history, you see that whether it's television, radio, the internet, all of them were there before they had the hockey stick growth. And this is the crazy thing with hockey stick growth. Possibly the best example is iPhone and BlackBerry. You sort of have this weird period before the hockey stick growth where everybody goes, oh, that's great and we should look at it, but it's not a serious thing. It's, we don't really have to pay attention. And it flips overnight to become the only thing that matters, and it concentrated minds. So I'm interested in Ray's perspective on this one, actually. Do you think, were we talking about different things? Would we be talking about different things if it hadn't been for the pandemic?
No, I absolutely agree with you. I don't think it would have been significantly different. The idea that we'd be talking to a client on Zoom, well, that was there, because there were developers all over Europe, or they're in different continents, disrupting the traditional players in the gig economy, that was there. It accelerated adoption, and I think the players who were ready with a very 100% digital offer, they took advantage of it. So it probably gave them a little bit of a capital boost in terms of the numbers and everything else. But I don't think it would have changed payment specific. I mean, it's changed a lot of other industries, clearly, and especially the way we work, I suppose, is the biggest thing it's really had an impact on. It's a funny story, but we're part of a larger group, and we were rolling out Microsoft Teams. We only had it live 2 weeks before lockdown. And I shudder to think about how our business would have operated without something like one of those technologies, Zoom or Teams or whatever. So I don't think Ali, I don't think it would have really made a big difference, for payments specifically.
What do you think the contactless limit would be today in the UK?
Well, it probably would be back down to where it was before. I can't even remember what it was, like 30 or something.
30, yeah.
But that's kind of irrelevant because Apple Pay and Android Pay is 100% anyway. I think clearly there are parts of the society who were not digitally savvy, who had to suddenly become cognizant with what a contactless payment was, or because retailers were asking for it, and particularly delivery as well, for supermarkets, for carers, vulnerable people. So it definitely had that sort of push. We had a big growth in digital vouchers for supermarkets to enable carers to buy the weekly shop for someone who was shielding. So there's some specific examples like that. But there was a momentum that's been there for 10 years. To your first point about the evolution.
Excellent. All right, let's talk ecosystems. When ecosystems digitize, there is that the belief that the system becomes globally uniform. Yet payment channels and the cultures around the world have significantly diverged. Great example for this is Mexico, where I always remember Doug on my team, who seems to spend a lot of time going out to Mexico and back again. But he highlighted there's quite a popular way to pay for e-commerce goods, and that's going to the corner shop. Yet, can you imagine the UK that if you want to go and do an Amazon, you actually have to go to a corner shop and pay there as opposed to a little swipe on your phone? Is this divergence in local payment methods, is this something that is going to continue, or do you think it's all going to become a lot more uniform? Simon, can I get your thoughts here?
Yeah, well, you've got Pix in Brazil now as well. And I think this local payments methods, I mean, anybody that's operated across Europe will tell you, you try to go to the Netherlands, you try to go to Scandinavia, that's a default. Like, you have to be aware of these market nuances. I think it's always been true. It seems to be more true in different markets as you go around the world. As I look at some of the companies expanding, one of their issues, so I was speaking to a company at a very large person who runs the payments team at a very large tech company. And what they were saying was, as we go into more markets, the amount of things we have to accept is really, really increasing. So our partners' ability to accept those becomes really, really key, just to acquire those payments in the first place. Otherwise, we can't expand because that's what everybody expects to use. So yes is the short answer. And we're seeing more of the payments types. But I think part of the reason that's becoming more of a problem for people is as these platforms, as these customers become global and want to expand into different markets, they're bumping into that. Outside of the UK and outside of the US, as you really start to look broader, there is that explosion had already been there for some time. You've also got not just the XPays, the Androids, the Googles, and whatever else. You've got the buy now, pay later providers with their own buttons. And so there's this explosion of payment types. Will that eventually consolidate? Will there be some sort of Visa for all of those sorts of things? Maybe. But at the moment, it seems like the more of these that a merchant has on their website, the more sales they're getting. So why wouldn't I add more buttons? And then you throw open banking into that as well, and PISP. It's exploding. I do think it eventually comes back around the other way, and the consumer headache becomes, okay, I've got 15 payment buttons, which one do I pick? And what's starting to get interesting, I don't know if anybody's used Shop Pay from Shopify. This is a really interesting development. If you use Shop Pay from Shopify once, for the first time, it's just a button and you click it and it's quite a nice checkout experience. The second time you land on a checkout page with that, it's really quite aggressive. It just goes, well, we've sent you an SMS, confirm the number, please. Okay, your payment's done. And we've got your delivery address stored. And it's kind of almost like, one way of looking at that is going, it's the good waiter who's already moved your chair, they've taken care of your jacket, the goods are on the way to you, don't worry, we've got this. And I could see how that increases conversion at checkout. The second thing might be, hey, I just wanted to look at my checkout before I hit the pay button. Like, whoa, that's kind of extreme. So there's going to be all of these innovations we see at checkout. It's a real battleground. We're seeing more payment types, but we're seeing innovation on how the payment type performs. And we're seeing that explosion globally. So I don't think this battle is done, not even by a long shot.
Ray, your thoughts, Nick? You must be dealing with all sorts of different payment methods.
Yeah, I mean, Mexico is actually one of our biggest markets, so I'm pretty familiar with that as well. I think the consistency is the user experience. I mean, the user demands the same thing in all of these countries. Yeah, they want to be able to pay conveniently. They want to be able to get out of the website checkout experience as quickly as they can. They expect a certain amount of convenience. I guess the level of security may change depending on the local environment. And I think that's probably one of the reasons why different markets become more divergent, is perhaps security standards vary. So those are the things that might change between one country and another, particularly, let's say, South America. We know security standards are not quite at the standard they are in Europe. Now, that could be a good thing for a consumer because it makes things super easy, but obviously it could also be a bad thing for a consumer in terms of level of fraud. The other thing, of course, is the tech and the legacy tech will also determine how those solutions work. So, as you say, if the payment network is not up to scratch, well, you go to a convenience store that's been accepting mobile payments, mobile top-ups, let's say, for 10 years. So it's already connected to a central hub. So then you utilize that network to make a bill payment, effectively using a legacy payment channel, which was used for topping up pay-as-you-go phones, and you use it for making bill payments. And that's been the case actually in a lot of markets, and that's particularly the case in markets like Africa, with M-Pesa and that sort of thing. But we look at those markets, the tech is kind of something that we can actually work with. So we might connect to, we connect to MasterCard, we connect to private schemes, we connect to specific networks, the banking system. So if we wanted to do, in fact, we are looking at things like Rappi and places like America, it's just connecting to that network. QR code acceptance as well. QR codes are used a lot in Asia and Americas. There's not really any difference between a QR code and a chip on a credit card. It's just a way of identifying yourself. So fundamentally, I think you have the tech and the regulation is the reason why you have divergence. At the end of the day, the consumer experience is always going to be the same. So it's always important to remember that. So maybe if the tech converges rather, yes. Will the regulation converge? Probably yes, more than the tech, because certainly in a lot of markets, Brazil in particular, they're looking at the EU regulation, open banking, etc., etc. So there you'll probably see more of a convergence.
Flip side of that, I always remember.
I thought you were going to say flipping heck.
Flip side of that is, I was remember in Singapore going into just any shop and there being about 20 different payment terminals to choose from, and it's obviously to figure out, oh yes, this you get more points on this, or this is better with this particular card, etc. There is also, particularly in China, Indonesia, you've got WeChat, you've got Gojek, you've got tech companies trying to become that super app out there. When I make a payment, I don't want to think about it. I want to take maybe an hour a week. It's no secret, I'm a big fan of Curve. I love just taking an hour a week to kind of go through my payments and kind of move what needs to go where with the time travel. I don't want to think about it at point of sale. I like the idea of not having to think so much about what payment is being done at what particular time. Do you not think that a combination of the rise of the super apps in the East almost makes having such a kind of a variety of different payments a little bit redundant by comparison? The fact that you can then, with something like Curve, go back and kind of choose it at a later date?
Culture matters and market context matters. So culture-wise, in sort of Indo-Chinese markets, especially towards Southeast Asia, you see that one of the core cultural principles is we've done, 11FS has done quite a lot of work in the region. And the thing to a Western eye that is confusing is how much value matters and value for money and feeling like I've got a good deal in everything that they do. And this is not for everybody, because it's the same as there are some things that are culturally important to the West that are not for everybody. So that's not every individual, but as a consistent theme, you see it much more as a cultural sort of observation than you would in the US or much of Europe, in fact. So how this manifests is with loyalty and rewards and offers, and the consumer is quite happy to have 5 or 6 apps and flip between them for the best offers. And those apps are quite happy to have different offers because it gets customer acquisition and it brings people through the door, and it's seen as a cost of doing business. And also, yes, the economics are quite different. I also think that you are dealing with markets that didn't have a lot of fixed infrastructure in some cases. And a consumer who was having a digital awakening and coming into the market with a type of payments that didn't exist before. So you can describe sort of China as the Galapagos of fintech. Things will happen there that wouldn't happen elsewhere because of the one-party state, because of the size of the market, because of the lack of historic infrastructure, because of the rise of the middle class. I don't know that copies and pastes into the West so easily. Facebook trying to launch their own stablecoin. Look at the regulatory backlash and look how far that's really come. Apple Pay has done really well, but it's been steady progress. Same with Android, steady progress. It's not taken the world by fire. And that's because it's hard to say that payments are really 10x better as an experience just from this one thing. So there's the sort of cultural bias, there's the geographic and the economic bias, and then there's the observer bias. So I like payments to work a certain way, therefore will the market not evolve like that? Well, I am of course not the market, and different people have different priorities. As you look at behavioral psychology, behavior change is actually very hard. And so getting people to adopt a new payment mechanism, you really have to, in order to cross the chasm past that first innovator and early adopter, you have to really solve a problem for people. You have to make their lives materially better. And whilst for you, getting that value for money out of Curve and going through it materially makes your life better, I think that experience needs to be something different for markets that we would call home to really flip a switch and to make that better. One of the areas I would look at for that, though, is what we're now calling buy now, pay later, what could eventually be an alternate payments rail. Because buy now, pay later isn't a point of sale lending solution. It's a shopping app that also does lending. And what these folks do is they aggregate many different merchants and they help you find new offers and new places to buy. And they help you manage delivery risk and you can send things back. And in principle, that could be good for a consumer. Set aside for the potential regulatory concerns, set aside that we could have a consumer debt crisis. Let's just assume that this thing is being adopted. Now there we might see a behavior change because this is, hey, that thing I wanted, I can pay for it more conveniently. why wouldn't I use that app when I see it at checkout for everything? So I do think we might start to see innovations come from that corner of the world. But payments change is very, very hard. Behavior change is hard. It took 50, 60 years for 50% of transactions to be on cards. Contactless is what, 20% after more than a decade? It takes time. And I think the classic quote, people overstate the pace of change and understate the impact, really, really applies here.
Absolutely. Ray, I've got to get your thoughts here in, to just bring it back around the rise of the super apps, but also how that pace of change works within payments and training people to change their behavior.
No, yeah, I think Simon's hit it on the head there, because I've been in payments probably 17, 18 years, so not as long as many, but if I go back to the first cards we did, mag stripe only, so magnetic stripe, no chip. You sign for them. I remember the day, PIN Day it was called, I think it was Valentine's Day. They used Valentine's Day as the first day you had to use a PIN on a card, I mean, that wasn't that long ago. And then, a lot of resistance from consumers. Well, I'm never going to remember a PIN. Why should I use a PIN? All that sort of thing. And then, of course, you had the contactless coming along, and a lot of people don't really understand. There's a whole perception that somehow it's, fraud and it's going to be a nightmare. And then that moved on to clearly. But the point here is it was incremental steps. With each step, you're doing a little bit of education and a little bit of learning of the consumer, because Simon's absolutely right. Explaining to a customer how a payment is going to work and how it's different from what they're used to, when payments are a very sensitive part of most people's lives and very wary of it, and when it goes wrong, it's very distressing, and obviously financially can be very expensive. And if you get it wrong the first time, that's it. So if you don't convert the customer to a payment experience the first time, they will not adopt it. They will effectively just go back to type, and it will be the anecdote about, well, I tried that, Apple Pay thing and it didn't work, so it's completely rubbish, or I tried that Android Pay thing. So it's incremental steps, but gradually, after 15 years of payment, as you say, we go from, a mag stripe card that you sign to a Shopify type experience, which is completely embedded, you don't even think about it, or a contactless ring or something like that. So you get there, but it is incremental. And no one, so you talk about the the WeChat payment experience, as Simon said, that is pretty alien, I think, to people's experience of how payments have evolved in Europe. So that is probably a very big step. So to get there, we probably need a few more steps in between before we're in that, I'm just going to send it. Because lots of people have tried to use messaging, as you say, and it hasn't really worked at all in the West, because it's just not the path we've been evolved on. It
is interesting about how, to your point about how those payments do evolve and move along. Jim McKelvey's got an incredible book called The Innovation Stack, and he's talking about how with Square, the first Square going into the audio jack part, and basically taking that mag stripe data and translating it to audio data, and the idea was to actually train people how to kind of swipe that, and the sort of psychology behind that was just a little bit out of my depth. I was reading that there. I was like, okay, I follow what you're saying there, but it's clearly been a huge success for them. Can I just bring back to what Simon was talking about around buy now, pay later? Has been in the headlines for many months now. It's been a couple of flexes have cropped up in the market. Do you think that this is something that is, in many ways, going to continue to evolve and almost take over payment and be kind of people's default, and so we kind of almost live a complete subscription lifestyle, so to speak?
Maybe not immediately, but the buy now pay later providers bull case, like if you're going to make the upside case for them, I think it would be that they're another payments rail and that they can do the thing that you can't do with cards. which is they can connect the buyers and the sellers into an ecosystem of loyalty, because that was always very, very hard via card rails. It's like, I don't know who my customer is. They land in my shop, they make a payment. Unless I give them this other loyalty card, I've no way of tracking them and seeing how often they spend. And I have no clue what they're doing in the rest of the market and what their interests and intent might be and how to reactivate them. What the buy now, pay later providers have done is to kind of create that ecosystem of putting those two sides together. And I think that's why Square, the office formerly known as Square, now known as Block, has acquired Afterpay Forward, because they have a consumer ecosystem and they have a merchant ecosystem, but they had no real way of connecting the data as long as they were reliant on cards to be doing that. But at the same time, the physics doesn't go away. Like that's the bull case. It could happen. I think there is a segment of consumers that really like it, but there's a couple of risks to that. I think risk number one is there is the potential for a consumer debt crisis that comes out of the back of it. There is the potential that regulation sort of really cuts the knees of what that experience looks like. And there's the potential for open banking to do exactly the same. In fact, imagine with open banking, I could see not only what transactions that have happened, I could request from the consumer to see where else they're spending as well, and maybe even offer them a discount in the process as a merchant. So then what do I need the buy now, pay later provider for? Where the buy now, pay later providers have really excelled, though, is in kind of getting that performance for the merchant. What they're really selling to the merchant is more sales. And I think that's been something missing from some of the incumbent banks historically, who've been selling payment acceptance. So knowing what your customer cares about and selling what they really care about is a strength, but there are some headwinds and tailwinds that I think faces buy now, pay later. And the jury's out, but it's one to watch for sure.
Absolutely. Ray, can I get your take here on buy now, pay later?
Yeah, I mean, we actually we've worked with Klarna for probably 6 or 7 years, and prior to that, we got very close to working with an early credit company you all know called Wonga, and Wonga I always feel were one of the first fintechs actually, because they took the concept of loans and said, how do we digitize the customer experience with the little sliders and everything else? So I do have a soft spot for those guys, but clearly they went too far, and that we all know what happened in the end. So with Klarna, I think this point that you can bring the merchant and you can bring the consumer much closer together and understand, frankly, the risks in the transaction, I think is where the BNPLs should focus, and where they can make the whole credit market better, as opposed to the relative remoteness of a credit card company who may or may not really know the customer they've given the card to, and they're not really doing a lot of analysis on the salary. As you say, Simon, open banking would help that, but they also don't really know the merchants that well. I mean, credit card companies will know kind of broad categories of the merchants. And with someone like Klarna, I remember it was interesting. It was no coincidence that the early adopters of BNPL, certainly in markets like the UK, were fashion. Okay, and one of the reasons for that was it's relatively high margin. Well, it is very high margin. Okay. So your typical high street shop or online fashion shop. So the risks of default are relatively low compared to lending on a car or something. But the second thing was the user experience, and it was always the case that a company like ASOS, they would have a 50% returns rate. So the user would be using BNPL to buy. There'd be a teenage girl or boy, but let's say a teenage girl would buy 3 different sizes of the same dress on BNPL with Klarna, try one, and then send the other 2 back before they even had to pay for it. So actually it was a way of solving a problem in terms of the checkout experience, So I would hope that BNPL is very, very focused, managing the risk, obviously understanding the customer better. And they should have, the ability. I mean, the fintech should have a stronger ability. I always remember Capital One, not necessarily you'd think as a fintech, we were one of the first credit card companies to really analyze data and create different cohorts of credit risk within their business. So I think the tech, the fintech, the way the BNPL companies are approaching that relationship between the merchant and the consumer, and if they plug open banking into it, then I think we have a much, much better credit experience. I think it's interesting your point about the subscription economy. Do we move? I think it's interesting your question about the subscription economy, because does everything move to installments in our lives? Everything we buy.
Well, the final thing I want to kind of touch to, God, I sound like an absolute book. I've got to reference another book. Highly recommend Manu Sadia's Trekonomics. It's about the economics of Star Trek and how they could have potentially got there, and buy now, pay later, and that kind of move towards almost like a sort of subscription for everything, as well as embedded finance and invisible payments is featured quite heavily, although not under those terms. If payments are becoming invisible, how will that change the next generation's perception of money? I have a small child that is at the age now with pocket money. Do I give coins, or do I use one of a kite card or something similar? It's trying to give that idea of money, and to take that to the extreme, do you predict that this will exponentially increase payments innovation in the future? Ray, I'm going to go for you first. What in nice big broad strokes is the future closer than we think? How do you think the next generation is going to see money?
Well, it's something we're quite passionate about. The company was founded actually on a product called Splash Plastic, which was a payment product for teens to use because they couldn't access the internet. So we created that. So we've got a bit of a history for that, and we support programs in the market like Nimble that they're really using, technology and a good mobile experience, but also education is something that they're very passionate about, in terms of that. And I would say, when you say tech savvy, Generation Y, Z, whatever you want to call it, and I've got 4 kids, who've all gone through that. They're tech savvy, but they don't really understand or really care about the tech underneath. Yeah. So they know how to make a PayPal payment, but they have no interest at all in how the payment ecosystem works. So I would say they just focus on, is this working for me? Yes or no? And the first time it doesn't work, they find another way of doing it. But actually, I think it does create a demand and an expectation that the experience is the best experience. But they are savvy about payments. I mean, all my kids, they have the ability to move around the market. So if they find that something's cheaper here, they can because they're used to comparison sites, or they're used to aggregators, they're used to being able to, in a few seconds, find the best deal. And I think the fact that they're using technology, because if I think of my parents' generation, and if you take something like a pension, they would be the pension that the guy turned up and knocked on the door with the suitcase or the briefcase, the man from the Pru. That's the pension they'd have when they were 20, and they'd have that till the day they died, and they wouldn't even think about moving. But when you have players like PensionBee coming into the space, or we've got a customer called Spride who's trying to get people to think about moving mortgages and more choice. And I think the generation of my kids, they will expect choice, and they will expect to switch. So they'll be brutal about loyalty. They will be brutal. They won't have any loyalty for any reason other than it's the best deal, the best experience. So I think the generation is actually going to move payments forward and move financial services forward, because the market is going to have to be able to be super competitive and adapt. So I'm very optimistic that actually it's going to move things forward in that respect.
Brilliant. I remember the splash cards actually.
Yes.
That absolutely. I haven't thought about that for years. That's brilliant.
Okay.
Simon, can I get your take here?
Yeah, a few quick thoughts. One, because of splash cards and everything like it, right? As I think about all of the cards that are available for teens, you've got this interesting problem where the user experience of that product is very different to their high street bank. So they actually end up using somebody else. There's this real expectation gap for people. There's a great study when I spoke to one of the high street banks where they were looking at doing something around physical toys and money and digital money and bringing the two together. And they found that children under the age of 7 couldn't associate with digital objects quite the same way as they could with a physical object. But once you get past 8, it almost flipped, that the digital object just made so much more sense. So they were trying to catch that sort of 6-7-year-old that's learning about money at school and coins and notes, and that physical association in the brain is really, really powerful. So it suggests that human psychology of anchoring might be very difficult to replicate until we are fully into the metaverse and we have digital objects that feel real. So that's going to be quite the interesting shift. But then as you go a little bit older up the age spectrum, as you're talking 10, 11, 12, 13, people live in Minecraft and Roblox and Fortnite, where numbers and points and money all look like the same thing. And what's happened that side of the world is that you kind of have, well, numbers are normal, it's all a game. And you have a generation of people that treat money more like a game and a high score. And some of them have done that very, very well. And to some degree, once you've got enough of it, it sort of is. And then there's the other side of it, which is money has become culture. It is much more culturally normal for the under 25s to talk about money amongst their friends in the UK and a lot of Europe than it had been historically. In the US, it was almost always more culturally relevant and normal, but now it's extremely prevalent, especially people who grew up in the shadow of the financial crisis, facing less likelihood of owning a house than their parents, less average income over their lifetime, a poorer pension than their parents. This is something where, the penny's dropped. People make fun of a generation of people for buying too much avocado and toast. They don't make fun of them for their rents being too high and asset prices being too high, because the generation before them lived off low interest rates and the asset boom. So there's going to be a massive intergenerational wealth shift. And I think with that, there's going to be a massive shift of who the core suppliers are and who the market winners are. And I don't know that joke has really landed yet with a lot of places.
Absolutely. Well, guys, thank you so much for taking the time to speak with us today. Simon, where is best to reach out to you, seeing as you haven't quite got to grips with the old TikTok yet?
Yeah, no, avoid that one. But you'll find me in the metaverse at SYTaylor on Twitter, or search for FinTech Insider on your favorite podcast client and check out 11fs.com.
Absolutely. And Ray, where best to find out and connect with yourself and PPS?
Yeah, definitely not on TikTok, I'm afraid. But yeah, check us out, PPS on LinkedIn, or Ray Brash on LinkedIn, and pps.com as well.
Brilliant, excellent. Thank you all very much. I'm Ali Paterson everywhere. We'll see you all very soon.